The term soft landing is going viral amongst investors in 2023 for the first time since 2008 and 2000. Will they be proven wrong once again? The number of stories with the word soft landing have been spiking over the last few months, while the term recession is actually going down in interest here in 2023 as more people are expecting the economy to pull through and recover past the tough economic conditions we've had over the last couple of years. What's interesting to note is we also saw a spike in the soft landing narrative here in 2006, and the same thing towards the beginning of the year 2000, right before, of course, the 2001 and 2008 recessions. And the soft landing is not just a story that's going around, but it's actually being priced in by the market as we speak. The S&P 500 has rallied significantly over the last 6 months, and that's been on the back of very strong earnings expectations from analysts that are forecasting S&P 500 earnings to grow significantly over the next 6 to 12 months and completely avoid a recession. Meanwhile, we have credit card debt that just hit $1 trillion. We've seen the consumer accumulate debt on credit cards throughout the entire year of 2022, and that's continued throughout 2023. And interestingly, the delinquency rate on credit card loans is growing at the fastest year-over-year rate that we've seen over the last 30 years. You can see this is the growth rate of delinquencies during the financial crisis. This is where we are today. So in this video, we are going to take a look at the 4 main arguments that are being put forward to justify that the economy is going through a soft landing and not heading into a recession. And we're going to be evaluating the accuracy of these arguments. We run a trading and investment service at gameoftrades.net to provide both investors and traders with the tools that they need to have an edge on the market. We currently have 12 active trades on the website right now. 4 of them have already hit their first target, including, for example, this short trade setup that we posted on Apple that broke down recently, quickly hitting the first target and now approaching the second target of this trade. We look for beautiful technical setups, both long and short, on individual stocks, indices, and commodities, providing you with a buy or sell signal level, multiple targets to book your profits at, and a stop loss in the event that the trade doesn't go our way. We're getting a lot of positive feedback from these trades that always apply the same rules, the same strategy, and provide a consistent risk reward on a diversified set of assets. We are doing a 20% discount on all the memberships for a few days here, so make sure to take advantage of that by clicking on the link down below. Now, before we take a look at the arguments for a soft landing, let me quickly begin by reminding you one of the key elements that goes in favor of seeing a recession, seeing a hard landing as opposed to a soft landing. The yield curve is a signal from the bond market that suggests the Federal Reserve that controls short-term rates, so the 3-month yield, has raised rates too high relative to long-term growth expectations, which you could say is determined by the 10-year yield. So when short-term rates are higher than long-term rates, that's a recessionary signal from the bond market. It also disturbs the entire banking business model because banks borrow from depositors at the short end of the curve at short-term interest rates, and they lend to people and businesses at longer-term rates, so the 10-year yield. So if the short-term rate is higher than the long-term rate, banks do not lend anymore, and that tightens credit and it precipitates a recession. This is a chart of the yield curve against real GDP on a quarterly percentage change, and the yield curve in this chart has actually been shifted forward by 15 months. So basically telling you the yield curve predicts what GDP is going to do, and in the past, when the yield curve has been inverted, 15 months later you get GDP contractions that start to appear. Whether you go back to the 1970s, the 1990s, or the 2000s, every single time you get a 15-month lag between the moment the yield curve inverts and when you start to have negative GDP growth on a quarterly percentage change. So we're not there yet. We're not 15 months post-yield curve inversion. The inversion actually occurred in August of last year, so we are around 12 months post-yield curve inversion, but we are starting to get into that hot zone where you could start to have some negative GDP growth as a result of the yield curve inversion. Now, despite these lag times being very well known by both the public and economists, investors are getting impatient and beginning to think that a recession is getting less likely from here. So let's take a look at some of the arguments that are being put forward for that. A big one is the household debt to service ratio that is low today. The debt service ratio is basically the interest payments that people pay on their mortgages or on consumer debt relative to their income. And so a low debt to service ratio suggests that disposable income is elevated relative to household debt. And this is actually a pretty valid argument to say that household balance sheets are in better shape than they were in 2008 when the household debt service ratio was at very elevated levels. So this makes the case for perhaps a shallower recession than in 2008, where household balance sheets were in very poor shape. Households had a lot of debt and very low income and were susceptible to really stop spending altogether and precipitate a deep recession. Now, of course, this doesn't mean that the consumer is not feeling any pressure right now. You look at personal interest payments, they've been surging recently as a result of both a substantial increase in credit card debt and a substantial increase in credit card interest rates. Personal interest payments, this chart here, makes up interests on credit card debt and auto loans. And you can see that increase in personal interest payments is translating into higher delinquency rates on credit card loans. Now, something to note here is that we are still at very low levels. So as we mentioned just a second ago, the household debt to service ratio is still low. And so that is reflected in pretty low delinquency rates here when you compare it to, for example, before the financial crisis, where delinquency rates were at 4.5%. Today, they remain at 2.5%, so quite low. Although, as we discussed at the beginning of the video, the growth rate on the delinquency rate of credit card loans is actually at higher levels than what we saw during the financial crisis. So although the starting point is a lot lower, delinquency rates are quickly climbing. So this is something to watch out for. If we continue to see delinquency rates grow at a very elevated year-over-year change, that could be a big warning signal over the next few months. But overall, the idea that the consumer is under less pressure than he was leading up to the financial crisis is accurate. Now, moving to the second big argument for a soft landing, that businesses are not feeling rate hikes because they locked in debt at very low rates. And when we look at this chart here of the interest paid by corporations, it's been flat since 2021. In fact, we are still at lower levels than before the pandemic. So the amount of interest that companies are paying right now is still very low. They haven't felt the real impact of the rate hikes that we've seen throughout 2022. But the counter argument against this is that this is not going to last very long. If you take a look at this line right here, it shows the amount of debt and loans that corporations have multiplied by the corporate bond yield. So this line right here essentially reflects what businesses are going to need to pay in interest based on the current bond yield and how much debt they have. And if you plot that against that chart that we just talked about, the interest paid by corporations that's been flat, there's a perfect correlation between these charts. And it's telling us that the interest paid by corporations is about to skyrocket because corporations have a lot of debt and corporate bond yields have risen significantly recently. So as soon as we start to see corporations hit their debt maturity wall and start to need to refinance their debt, they're going to need to do so at much higher interest rates. And as we can see from this chart here, a surge in interest payments by corporations often precedes recessions that happened in 2000, that happened in 2006. But what this chart does show is that it hasn't happened yet, and it could take a while before corporations really feel the impact of higher interest rates when it comes to the pressure they have to pay back their debt. The third argument behind the soft landing narrative is that we currently have elevated nominal GDP. Nominal GDP growth on a year-over-year percentage change is still above 5%. So the economy itself is growing very quickly. In fact, GDP is actually growing at a faster rate than anything we saw in the post-financial crisis period between 2009 and 2020. So economists and investors are pointing to this hot GDP growth and saying, we cannot have a recession in this type of environment. But of course, that's not true. You just have to zoom out a little bit and see that during the 1970s, you had multiple recessions occur with nominal GDP growth staying above 5%. You can see 1970, 1975, in the 1980s as well. And of course, you saw the stock market decline significantly during these periods, despite the fact that year over year GDP growth was very hot during that period. You still had pressure on the stock market. Now, moving on to the fourth argument behind the soft landing narrative is that the labor market is remaining strong despite the yield curve inversion. You can see this is a chart that plots the change in the unemployment rate after yield curve inversions. You can see what typically happens after yield curve inversion. All of these are the different episodes post yield curve inversion, and that dotted line is the median. What typically happens is you see the unemployment rate begin to rise starting at around 10 or 11 months. So far, we haven't seen any rise. So far, this argument is actually true. We have a more resilient labor market than what is typically seen after a yield curve inversion. And we at Game of Trades expected that the labor market would show a little bit of deterioration by now, and that hasn't materialized yet. And you can see another example where we never saw the labor market deteriorate after the yield curve inversion was 1965. And this is actually the only yield curve inversion that did not play out for a recession. So if we continue to see the labor market be very strong like it was in 1965, it could be a good argument for the fact that the economy has been able to avoid a recession and that we actually did see a soft landing. However, as you can see from this chart, it's probably too soon to actually say that the labor market is out of the woods right now. Most of the deterioration in the labor market occurs starting at month 14. That is when you start to see more substantial moves up in the unemployment rate. And most of the deterioration happens between month 16 and month 24. If I can throw out a prediction in this video based on this chart, by the end of the year, we could see an unemployment rate above 4%. And by the end of the year, that would be around month 15 post-yield curve inversion. You'd expect to see the unemployment rate be around 0.5% higher than it was when the yield curve inverted, which would take us to around a 4% unemployment rate, and when investors could start to pick up on a trend of a weakening labor market. And of course, this is very much in line with this chart that shows us that monetary policy is a 15-month lag.